Okay, I'm back. I hope you're all back as well. Looks like you're all online. Hopefully you are there. Okay, guys, so now we're going to have a look at test 2. Let me just have a look here. George, yes, absolutely. If you, when we start the next session, yes, I always start out by asking you guys if you have any questions, and it doesn't matter what the question has got to do with it, you can certainly ask me, that's fine. Just the date, I must actually still, just hold on. I think I'm on page now, 29. Let me just get my calendar out, for my week planner out for next week. Third years, I will see you only, not next week, I'll see you the week after that. Just get this out here. So not in week 29, I only see you in week 20 again, that's on the 20th of July. And then the last one will be the 27th of July, where we'll conclude. Okay. Okay, so let's have a look at test 2. So remember, test 2 is your learning units 3, 4, and 5, risk and return, interest rates, and bond valuations, and share valuations. And we did cover these chapters last week when I saw you, so hopefully that has helped you. Okay, so how many of you still have to do test 2? How many of you have submitted test 2 or still have to do test 2? Anybody submitted test 2 yet? Okay, so I think this is probably, yeah. Okay, so some was in, some not, and some in the process. Okay, all right, that was kind of what I was expecting. So from test 2, the same with my students, I've got probably approximately half of my students that have submitted it and the other half haven't yet submitted test 2. So guys, this is where we're making the big push for all of you students, is to really get you to buckle down now in the next week of July and get your test 2 in, so that you've then got the rest of July to sit and work on your exam. Because the best plan is that by the end of July, you have submitted everything, 1, 2, and the exam, which will then give you the month of August if you want to do a second submission for any one of the 3. Okay. All right. So that's good. That's good news that some of you have done it. You're not quite. So question 1, let me just go back to the first page here, comes from Learning Unit 3, which is on risk and return. And it says that the manager of cruise investments, who specializes in investments for clients who are nearing retirement age. So just be very careful when you read this. They've given you all this information for a reason. They are analyzing whether to switch their clients' funds from the current investment in asset delta. So currently they're, sorry, I don't know why that pointer's not moving. It seems to be stuck up there. Who knows? Okay, so currently their clients' assets are invested in asset delta. They want to know, should they now take it out of asset delta and move the investment into asset alpha? So basically what they've got to do is choose which one of these 2 assets is going to be the most profitable asset to invest in. Okay, also given that these are retirement age clients, so they can't take on too much risk, and they provided you with the following information for asset alpha, okay, which is the new one, and asked for your independent analysis. Mr. George, yes, if you go to bootcamp resources, there is a document there that you can click on. It's just a blank Word document that I have left there, and it's headed please use this document to ask any questions. So if you click on that document, it should allow you to write on it, to edit it. The document is editable and you should be able to write anything on that document. So I will check that document and I'll be able to see if you've left a question on it for me. Unfortunately, because of the way that they've set up VC Learn, that's the only way that you can communicate directly with me is through the document that's uploaded into that extra resource calculation. I did give you guys my email address. In the first class, I'll just write on here again. Just check it if you had That's my email address. If you can also send me an email. And guys, if you do send me an email, just give me the module code and the fact that you are a bootcamp student so that I know exactly who it is that's contacted me, because just that I know exactly what the reference is. Okay. Or just use the document you've got access to. Okay, so again, it comes down to reading the question carefully so that you know exactly what information have they given me and what is it that they want to know. What do I have to work out? What do I have to advise them on? And in order to give them the advice, what calculation do I have to do that will give me the answer that I can then explain to my clients? Okay, so we are already invested in asset delta. I have to calculate the profitability of asset alpha so that I can then compare that to asset delta and then decide which one is best. Okay, so here's the information. I have got 5 years of information, or what did they say, economic state, 5 different possibilities. These are the different returns, okay, over 5 different, let's call them years. I don't know why they've called it economic state at the top there. Those 2 are positive, which means that they made a profit. In this 3rd year, that's a negative return. Please take note of that, which means there was a loss or prospective loss. And then again, 4 and 5 are profits, positive figures. And then over here, what are you guys going to do in this probability column? Do you remember when I explained to you about the probability? I mentioned several times that when you look at your total probabilities, what has to happen there? I can't tell you. You will find it in your textbook, but they've got a question mark here for the probability for that last return. Why is that? And what will you put in there? What will the probability for that economic state number 5 be? You can just type it into the chat box. Perfect, exactly. Exactly. Okay, everybody see that? Mr. George, he said, all probabilities must equal 100% or 1 whole. Okay, so that will tell you what to do there, because you have to, yeah, exactly. You have to calculate that first, knowing that little bit of theory before you can then go ahead and calculate the expected return for asset alpha. So your 1.1.1, calculate the EV or expected return for asset alpha for 5 marks is relatively simple. The tricks for those 5 marks, guys, are going to be that you know what you have to use for the probability for alpha, and that you please remember that the return for 3 is negative. Okay. So you work out the individual weighted returns, you add up, and then the answer of the 5 added together will then be your expected value. And then calculate the standard deviation for asset alpha. So that, again, that's straight out of the textbook. You'll follow the, let me just find this on the right page. get to the right chapter here for you. So your standard deviation is on page 74 in your textbooks. Okay, and can you remember what I said at that? For standard deviation, we have got two formulas. And remember, you would have got a formula sheet. You have got a formula sheet with this test. So you can download a formula sheet and use that, or you can just use your textbook. That's also obviously fine. So which of the two formulas are you going to use to calculate the standard deviation for asset alpha? Remember, you've got two formulas, and can you remember what I said? What's the difference between the two formulas? There's only one instance in which you can use the one formula, and if you've got some missing information, then you have to use the other formula. You remember? So for this 1.1.2, very easy, excepting you've got to choose the correct one of the two formulas. Okay, so that's your trick there, and if you can do that, your 7 marks is easy, because that would also then, you'll just follow the example directly out of the textbook and you'll do that. And please, guys, also here, take notes in bold, round off your answer to 2 decimal places. In financial management, we never round up to whole numbers when we're doing calculations like this, because we need to be very accurate, and we can only be accurate if we include decimals. So in financial management, we always work to 2, 3, 4 decimal places. Don't round your answers up to whole numbers unless they've specifically told you to do that. Okay, so take note 2 decimal places, otherwise they will have to deduct a mark for you. Otherwise, those 7 marks will be easy. And then also following directly on from this in your tech is then the coefficient of variation. Okay, so then for asset alpha, you must calculate the coefficient of variation. And let me just tell you how many marks there are for doing the actual calculation. So out of those 4 marks, 2 of those marks are for doing the calculation correctly. And then the other 2 marks are for the rest of this question, where it says now, importantly, advise, okay, whether they should switch their clients' investments to alpha or whether they should leave them with the current fund delta. And then they now, only here they give you asset delta has got an expected return of 4.5% and a coefficient of variation of 0.45. Okay, so look at your 4 marks. 2 marks are for calculating coefficient of variation for alpha. 2 marks are for your advisement. They've given you 2 pieces of information. So you will get 1 mark for choosing between the 2 expected returns and explaining which is the most preferred one. And there will be 1 mark for comparing the 2 coefficient of variations and explaining which is the preferred one. Does that make sense? Okay. So this is what I'm trying to teach you, to break down the number of marks allocated, what they've asked for. You always carefully work out how you're going to divide your answer amongst those marks to make sure that you don't leave marks lying on the table. Okay. And the only thing to say to you here for 1.1.3, remember that when giving this advice, your clients are retirees. Okay. They are nearing retirement age. So you have to take that into account when you're giving the advice. And that is from a point of view of their risk profile. So that also includes the discussion in Learning Unit 3 of the 3 different risk profiles or risk preferences that different sets of investors will have. Makes sense? Okay. So when you're answering these questions, you've got to take into account the whole full picture of everything that we've taught you. Okay, then 1.2, Cruise Investments has also asked you to analyze a well-established company, Neptune Limited. Okay, so we're also going to do some calculations given some information about Neptune Limited, and then we also have to come to some kind of conclusion about whether we think it's a good opportunity or not. And they have asked us to tell them whether it represents a buy opportunity. A buy opportunity means, should I invest in this company and buy their shares or not? So we've determined that Neptune Limited has got a beta, do you remember beta? Coefficient of 2.5 times the market beta. So they don't say that Neptune's beta is 2.5. They say its beta is 2.5 times that of the market beta, which means you've got to consult your textbook to find out what the market beta is always considered to be, and then multiply that by 2.5 to get the beta for Neptune. Okay. The market risk premium is 2%. The risk-free rate of return is 5%. And in addition, the following dividend history has been provided to us, and it's expected that the dividends will grow at the same constant rate achieved over the past 4 years in the future. So they've given us the actual rand values of the dividends for the last 4 years, but they didn't tell us what percentage rate those dividends were growing at. We have to calculate that given this information. Okay. All right. So let's work our way through 1.2.1. First of all, calculate the cost of equity using the capital asset pricing model. So you're going to go to your textbooks, you're going to look for the CAPM formula or on your formula sheet. Given all the information that they've given you here, you'll substitute the information into the variables and you will calculate CAPM. Okay. And can you remember, what did I say CAPM, and I reiterated it a couple of times? CAPM calculates what? It calculates a percentage, but what does that percent represent? And this is important because we use CAPM formula several times throughout the year. And we have to know that that percentage that that formula gives me is telling me what? About the company that I'm calculating it for. Capital asset pricing model tells me what the required rate of return should be for that particular company. So in other words, if I am going to be taking on this risk, so for Neptune, they've got a beta coefficient of 2.5 times that of the market. So that tells me that Neptune is 2.5 times more risky as an investment than the market in general. So given that, what return should I expect from an investment in Neptune in order to make it worth my while to say, yes, go and buy Neptune's shares? Okay. In this question, they have called it the cost of equity, which is, where did that go? They've called it the cost of equity. And there are a couple of interchangeable terms that we use there, which is required rate of return, cost of equity, cost of capital. All of those are interchangeable when we are calculating that percentage that either I require that investment to return to me, or that is the return that that investment is going to give me. Okay, so that's for 3 marks. Then 1.2.2. So now using your answer in 1.2.1, we now have to use the dividend growth model, okay, which is a different formula, to now advise Cruise Investment whether they should purchase these shares in Neptune if the shares in Neptune are currently listed on the JSE at 50 Rand per share. So they're giving us what the current selling price for these shares is. They say currently selling at 50 Rand. We've got to work out, is that 50 Rand a bargain or is it expensive? And then advise accordingly. So that basically means that we have to calculate what the expected share price should be for Neptune, given their rate of return, etc., and then compare that to the 50 Rand that the share price is currently selling for. Okay. So for your final answer, you must calculate what the price is that you would expect to pay for Neptune, given the information, and then compare that to the 50 Rand, and then say, yes, I should buy it, or no, I shouldn't. Okay, so what the part that I was saying there is, so what you're going to calculate here is, given the information that you've got, your required rate of return from CAPM 1.2.1, you're going to calculate the value for G, okay, using Learning Unit 2. You'll find the formula for that in Learning Unit 2 at the end of the chapter. And then using that information, you are going to calculate the minimum price that you should pay for Neptune Limited. Then you're going to compare that answer to the 50 Rand that the market is currently charging for one share of this company. Okay. And then that will tell you, is 50 Rand, yeah, go ahead. Go ahead.
Ma'am, just with that, with reference to that, on page 126, you have two different growth models, well, calculations. The one is with your constant growth and the other one is with your variable growth. Now, according to the question, they specifically point you towards the constant growth. But if you do go and you look at the growth and try and calculate the growth rate or any of that, you can see that there is no constant growth between the years. They all, do you then try and calculate a weighted average growth rate, or
exactly. So yeah, so if you remember, let me just find the page number. If you go to page 52 in your textbook, go and have a look on page 52, Learning Unit 2. So they are expecting you guys to remember what you learnt in Learning Unit 2, because remember I said your time value of money and your risk and return chapters, that's kind of like a base that you're then going to use and apply in all the other chapters. So on page 52, where am I? Finding growth rates 2.9.5. Example 2.17. You've been presented with 2.17. You've been presented with the following stream of cash flows received from an investment. So that stream of cash flows could then be the dividends that you've received from the investment. And then at the top of page 53, using the present or future value formula, we can then calculate what the average growth rate is over the course of those 4 years. So in other words, yeah. So in our dividend growth formula, constant growth, on page 126, PO equals D1 over K minus G. We're going to calculate what D1 is, given the growth percentage. K is going to be our answer from 1.2.1, and we have to calculate G using the same method in example 2.17.
Yes.
So your okay.
PO would be the share price of 50 Rand.
It won't give you 50 Rand, it'll give you some other answer. So basically what we're calculating is, given the growth rate and what the dividends currently are and what the value for K is, which is the required rate of return or cost of equity, what should this share be going for in the marketplace? So that's what the answer to one. Yeah.
So basically we can work out through our CAPM from 1.2.1, we can work out our our K, and from page 52 we can work out our G. Then we still have our expected dividends to be received in the next period. But that we calculate by using the percentage times by the dividends you got now to increase.
Yes. Yeah,
And
you'll
then
take your
you can work
last.
out your P.
Exactly. Exactly. Yeah, you've got it exactly right. So if you look at, yeah. So in other words, your last R4.15 dividend, if you look at the screen, it says there that's current, which means that's D0. D times 0 is 4.15. And in our formula, we need D1, which means 2020's dividend. So you will then, your first calculation for 1.2.2 has to be calculate the value for G using example 2.17's method. Then apply G to R4.15, which will give you D1. And then using your answer, which would be K from 1.2.1, you can then calculate PO.
Okay, thank you, ma'am.
Okay. And then importantly, there is marks allocated because they have then said advise. Okay, so there's marks allocated for then coming to a conclusion. So there'll be marks given for all those calculations, but then also you then have to say, okay, so I've calculated that PO equals, so this is the value that the share should be trading at the market on. How does that compare to the 50 Rand that it's currently trading? And then you're going to say, yes, buy it because 50 Rand is cheap, or no, don't buy it, 50 Rand is expensive compared to the answer that I got in this above calculation. Okay, so don't forget to give that conclusion as well, because there's one mark allocated.
It's going at a premium or it's going at a discount rate? Is it fine if you use that terms? Would it be fine?
That's absolutely exactly perfect. You can say a premium or a discount is 100% correct, or you can say it's overvalued or undervalued. Anything that indicates that you know whether it's that price of 50 Rand is cheap or expensive. Okay. So this question is a very good example where you can see that, and financial management second year and third year works in the same way, where you have to apply all the previous learning units to every learning unit that comes after as we go along. Because we have to, what we're doing, we have to teach you certain concepts, certain formulas, certain calculations that you then need to use for more complicated decisions that we make further down the line in the year. So financial management is not one of those modules where you write off each learning unit individually in its own little silo. Okay, so whenever you are looking at a question, always think about what did you learn in the previous learning units, even going back to second year, because we constantly apply that to questions. All right. So anybody else got any other questions of question one? Did you all understand what you're calculating there? It's not a difficult question, and the calculations aren't difficult. So from a mathematical point of view, it's just knowing which calculation to do and which formula to use. So then our question two, this first one is very easy. For 4 marks, calculate the real rate of interest using Fisher's formula. So just look in your textbook for the page that Fisher's formula is on. It's also in that risk and return section where they discuss interest rates. And use the formula, and then they've given you certain information. You've got to calculate. They've said inflation is expected to be 1/3 of the nominal rate percentage. So they've given you what the nominal rate is. You calculate 1/3 of that and use that for the inflation rate, and then you can calculate the real rate of interest. But you must use Fisher's formula, otherwise you won't get all of the marks. Okay, so that's an easy 4 marks, that one. Then question 2.2. Again, you'll see that because you guys are second years now, almost all of the questions are saying, please advise, okay, the client. So in other words, you have to do calculations, but then you have to be able to interpret your answer to those calculations. That's critical for second year and also carrying on to third year. So your client has asked you for advice as to whether he should purchase bonds. So we're now doing bonds, which is learning unit 4. Sorry, interest rates is in learning unit 4, not 3. So 2.1 also learning unit 4, interest rates, and then 2.2 is bonds. Whether he should purchase bonds in a particular company who is on a major expansion drive and urgently requires additional financing for their project. So you guys, that's why companies sell bonds. They sell bonds in order to raise funds for a specific project that they want to undertake, or if perhaps they want to purchase a new company, then they sell bonds in order to raise the funds to do that. And bonds is just an alternative source of funding for a company. Instead of selling or issuing new shares in their company, they rather sell bonds, because bonds is more like a loan, whereas shares is permanent funding. So they're offering the following bond to individual investors via online applications. So this is the information about the actual bond itself. It's got a par value of 50,000. So remember, that's the face value. So if you were looking at a note of currency, say like a 200 Rand note, the par value is that 200 Rand value that's printed on the face of the note. Okay, so that's permanent and unchangeable, that 50,000. The price today means how much is that bond currently selling for in the markets. It's selling at a discount of 5%. So the discount is to its par value. So in other words, it's selling at 5% less than its face value. The coupon percentage is how much interest does this bond pay per annum, which is 14%. And also remember that the coupon percentage is always paid on the face value of the bond. The amount that's printed permanently on the bond, that 14%, is multiplied by that value. So in that case, it will be the 50,000, not the current price, market price of the bond. It's for a period of 20 years, which is also fixed. And the interest is paid quarterly. That's very important. So remember, the value for I for interest is 14%. And the value for M, number of times that the interest compounds per annum, M for Mary, is going to be 4. So advise Mr. Stokes whether he should purchase the bond, knowing from your dealings with him that Mr. Stokes, so when they say he has, Mr. Stokes has got a required rate of return of 13.5% for his investments. So what they're telling us there about Mr. Stokes is that Mr. Stokes will not invest in anything that will earn him a lower rate of return than 13.5%. Okay, he requires an investment to give him 13.5% or above, otherwise he's not interested in buying it. Not the coupon amount. Let me just try and, you want to calculate for PMT? Yes, the PMT would be then the coupon amount divided by 4. In other words, your 14% per annum is being paid to you in 4 separate amounts, adding up to 14% per annum. And again, if you look in your textbooks, you'll find, oh, is that the end of the question? Sorry, I thought there was something else there. Let's just go back. Okay, sorry, they haven't, usually they put here required. But this, advise Mr. Stokes, this is the required. They've just left that off. Okay, so this is not a difficult question. So basically what you're going to calculate is, given this information, what is the value for this particular bond? Sorry, not the value. What is the rate of return that this bond is going to provide for anybody who purchases it? So what is the rate of return that this bond is going to provide for anyone that purchases it? And then you're going to compare that rate of return to the 13.5%. And if it's higher, you'll say, yes, he should purchase the bond. And if it's lower, you'll say, no, it's less than his required rate of return. He shouldn't purchase the bond. So once again, you are going to be solving for the value of R, which means you are going to be, let me just find a place in your textbook, 22. Sorry, let me just find the right page number for you. Page 111, yield to maturity. That's basically what you will be, your calculation here will be what is the yield to maturity for this bond. YTM, it is basically calculating, if I purchase this bond, what would be my return if I purchased this bond? What would be its yield return to maturity if I kept it for the full 20 years? Okay. Does that make sense? So you've always got to look at what information they've given you and then what's the missing variable, and then you obviously have to calculate that missing variable. Okay. And guys, for financial management, that is your biggest challenge. The actual calculations are not difficult. It's deciding which calculation I have to do in order to answer this particular scenario. And then question 3, you've been provided with the following extracts from the Statement of Financial Position of Conversion Limited for the year ending 31 August 2019. Purchase price. What was the 5%? I can't remember. Yes. The price that the bond is selling for is 50,000 less 5%. The price today. So that's the price that you could purchase it for. Yes, or the present value exactly. Yeah, that's correct. Yes, exactly. Future value is the par value, because remember that par value doesn't change. It will remain 50,000. So at the end of the 20 years, you will get back exactly 50,000 Rand when you return the bond and they give you your money back. Okay, so this is an easy one for 10 marks. Calculate the book value per share for Conversion Limited. So remember also in your share valuation chapter, we are given several different methods of valuing a company. Page 117. So right at the end of the chapter, page 138, they have got other valuation methods. That's the free cash flow, dividend growth, and price earnings valuation method. We've also got book value or liquidation value method. So this is the book value method, page 138. That's quite simple. You can read in your textbooks there exactly what approach you have to take to calculate, to value the company using book value. And then you should easily be able to get your 10 marks there. There's no tricks that you won't find in the examples in the textbooks. Okay. Just take note here where they say non-current assets, goodwill accounts for a quarter of this value. Just take note what they say about taking goodwill into account when we are using book value. Okay. Jean, you're asking how do we get PTM? Do you mean PMT? For which question, Jean? For the previous question? For question 2.2? Your PMT, so if you So, yep, okay. And you're talking about 2.2, yeah? So what is PMT? PMT is the rand value of the regular annual amount that I will get paid. So if you look at this information on the screen now, what rand value will the holder of this bond receive every single year for 20 years? It will be the amount of interest paid to them. And how do we calculate the rand value of the interest that will be paid? Remember, I said the coupon percentage doesn't ever change and the par value doesn't ever change. So the PMT will always be coupon rate multiplied by the par value. Okay. Okay, so just this is the only trick here is just read up about goodwill, what you must do about that. The mortgage loan, the date that it's due. Okay, so take note, we are doing this valuation for the year ended 31st of August 2019, which basically means at midnight on the 31st of August 2019, which will be the last minute of the year end of this company, what will the book value of the company be? So if this mortgage loan here is payable in full on the 31st of August, that means at some point during the business day of 31st of August, I have to pay that 650,000 Rand back, which means that at midnight on the 31st of August, that 650,000 Rand will no longer be owing. Yeah, can you follow that logic? You must be able to make these conclusions when you do these questions. Okay, inventory, receivables, payables, nothing funny about that. And the share capital, they've given you the total value of the share capital and what the current price on the JSE is, as well as the nominal value per share. The nominal value per share means, again, if you think about it, I always try and tell my students, think about it as a piece of paper, like a note of currency. If someone's giving you a 200 Rand note, if someone is giving you a share of this company, what is printed on that share, the nominal value will be the Rand value that those shares were originally issued for, which was 11 Rand per share. But currently, if you happen to purchase one of those shares on the JSE, you could buy one for 4 Rand per share. Okay. But again, just have a look, what of those amounts do you have to take into account if you are using the book value method? Okay, but that's all very clearly explained in the textbook. Anyone got any questions about 3.1? The nominal and the current. Okay, so when shares are sold, have you guys heard of an IPO, initial public offering? That means that's the price that the share was initially sold for when the company first issued the share. And that's the money that the company received. So the 88,000 Rand is the money that the company received when they first sold those shares for the very first time in the open market. And making up that 88,000 Rand, they received 11 Rand per share. Okay. So you can therefore calculate how many shares are in existence making up that 88,000. You've got to take the 88,000 and divide it by the nominal value of the share in order to calculate how many shares there are. But that was in the past when the shares were originally issued. So maybe the company hasn't been doing so well since then. And currently, if you purchased a share from another investor on the JSE at the moment, you would only have to pay him 4 Rand to get one of those shares. Okay, so the market price is 4 Rand per share. The nominal value is the amount that was originally paid when those shares were first issued. Okay. Good. And then question 4 for 15 marks. It's a listed company, which means that they have shares in issue, and we are considering buying this company. So we have been asked to undertake various valuations and analyses of the business so that we can take this decision. And we've got the following financial information, equity and liabilities information. And then using that information, I've got the forecast profit after tax, which means for the next 3 years, this is what we're expecting profit, retained earnings, and dividends to be. And note that that is after-tax profits. And then included in the calculation of the after-tax profit, I have taken the expense of depreciation and amortization into account, as well as an interest expense. Okay, so depreciation and interest expense are two expenses that would have reduced my profit prior to me calculating what the profit for the year was. And remember, yeah, that's after tax. And here's some additional information: cost of equity, weighted average cost of capital, the company's beta, price earnings ratio of the average industry PE, all sorts of information. And here for 4.1, they say using the PE valuation method, calculate the value of this company. And they say, hint, use the 2020 forecast as your basis for the calculation. Okay, so in other words, your 2020 forecast, your latest forecast, you're going to use that as your basis. And there is a question in your textbook almost identical to this. I'll have a look in a second now to see if I can find the question number. And then 4.2, again, now you're going to put your thinking hats on and do some analysis so that you can advise the management board of any 2 reasons why you prefer not to use the dividend growth model to value companies. Okay, so here you have chosen to use the PE valuation model as opposed to the dividend growth model, and you have to explain 2 reasons why you have done that, or 2 disadvantages to using the dividend growth model. Okay. And take note, guys, there's 4 marks allocated to that, which means 2 marks per reason. So make sure you write sufficient for each of those reasons, that there are 2 facts to each of those reasons. Otherwise, we can't allocate you the full 4 marks. And take note, your PE valuation model, it's only 3 marks. So don't go and write some long, complicated, or think that the calculations isn't some long, complicated thing. Always go and look at how many marks are allocated, and that will give you a good indication of how long your answer should be. And then for 8 marks, the last one is calculate the free cash flow for 2020 only. And you can see that these lecturers who write these papers know that the students will go and calculate the free cash flow for all 3 years, because that's what they always do. If they're only asking you for 2020, then please only calculate 2020. You don't need to do the rest. And also, I'm just pointing out to you, note that they have asked for the free cash flow and not for the free cash flow valuation. There's 2 different calculations there. If you go and look at page 130, where the free cash flow valuation model begins, you'll see that in order to calculate the free cash flow valuation, our first step in our calculations is to calculate the annual free cash flow for whatever the forecasted years are. So it's that first step that they've asked you for here in 4.3. Okay, are you with me there? So in other words, in example 5.4, that's where we have calculated the free cash flow, which is what you do for 4.3. Okay, just the FCF. And then over the page, on page 133 in example 5.6, that's when they are using the free cash flow valuation formula to calculate the valuation, which is something different. They're not asking you for that. And the reason I'm repeating that is because I know that that's what the students will go and do. They'll do the wrong. Read carefully and calculate and answer what they asked you for, not what you think they're asking you for. Okay, sometimes it's easier than you think. They're not asking you for the difficult bit. Okay, guys, so that is the end of question paper 2. So hopefully that's helped you apply the theory that we learned in the last 2 classes to the actual papers themselves. And the only thing I can really help you with mostly is to watch out for all the pitfalls in the paper that I know that the students regularly make. You just got to stay wide awake and make sure that you are reading carefully, answering what's asked, following instructions, and that you definitely will do well then. Even if there's the odd calculation here or there that you're not sure about, you'll definitely do very well. Okay, anybody, any other questions before we finish off? It's a very nice paper. I don't think there's anything wrong with this paper. It's super nice. And it's pretty straightforward. As long as you know, it's straightforward if you know your work. Okay, all right, so I'm going to switch off the recording if this thing will open. Okay, it's a pleasure. I'm glad it was helpful because that's our main aim. So if I hear you saying it's helpful, then I'm happy. Okay, guys, fantastic. Thank you. All right, so I won't see you next week. I'll see you the week after on the 20th, and then we'll start exam work. Okay, guys, bye.
Sorry, ma'am. Sorry, ma'am.